Welcome to the channel on banking made easy for the beginners. In the last episode, that was the first one where we were talking about various deposit schemes. In this episode, we will see the recap of all the deposits and advantage of cash in hand and the disadvantages of having the cash on hand. So, when we compare the bank deposits versus cash on hand, there are both plus and minus. Let us see the pros and cons of having cash on hand. First, the advantage of having cash on hand is it is easy to access, easy to spend, readily available. For any contingency it can be used, and no KYC is required. And more than that, like for example, there is a bank holiday, bank strike, or band, some contingency, unforeseen circumstances, not necessarily emergency at our side, outside in the system, if there is an issue, cash is always available with us. So these are the plus points. And in the any economy or in any country, some amount of little amount, even if it is very little amount of cash is necessary for day-to-day running the household chores, or if it is business, same thing, much more will be needed. And there are some payments which can be made only in cash. So in all those things, we need some amount of cash at least for our own safety and comfort. Minus points we discussed last episode itself, like it doesn't offer any return. Matlab, there is no interest we are getting for the deposit cash which we are having in our hand. Secondly, the risk factor is always there. We never know when it is lost, and it can be easily spent also, because we don't have any control. When the cash is readily available on hand for spending, we may be tempted to spend it very fast and easily. Before we realize where it happened, it might have already gone out of our hand. That is another risk on having cash. So the point or the break-even point which we can say is to have a sufficient amount of cash, not too much cash on hand, based on each individual's requirement. Now we will see the advantage or the salient features of the various deposit schemes which we discussed. First we discussed about the savings bank account, which is commonly called as SB account. S for savings, B for bank. Savings bank account is normally called as SB account in day-to-day communication. SB account visa, it is best to having cash on hand, more safe. It gives return in the form of interest to us, and anytime we can withdraw, easy to deposit. So all these plus points we saw in savings bank account. And we also had current account for the business people, which is equivalent to savings bank account. The only difference is there will not be any interest payable for that. We will not earn any interest for the money which we are keeping. That is for the current account, mainly for the business people, and savings bank account is mainly for individuals and personal needs. So these were the two differences. Basic structure of these accounts are the same. Basic purpose of these accounts are the same. One is for our personal need, another is for business need. Suppose an individual is having a business, he can have both the accounts. One is for his own individual as a savings bank account, and for his business purpose or her business purpose, a separate current account can be operated or opened. So these are the two differences between savings and current account visa. Then almost we were talking about the recurring deposit and fixed deposit. Fixed deposit is also called as term deposit. Fixed deposit in short term, in the short form, it is called FDR, and same way the other name for that is term deposit, which is called as TDR. So both are same. In this case, the money which we are depositing cannot be taken immediately, because there is a period up to which we have agreed to keep it. That is why it is called as fixed deposit. For a fixed period, it can be, say for example, 6 months, 12 months, 1 year, 2 years, 3 years, 365 days. Some banks are also offering deposits for odd days, like fancy days, like 444 days, 555 days, 1000 days, 999 days, like that. You can, combination can be anything, but the main point is it is not for day-to-day operations, it is for a fixed period. So that we saw. There are advantages we saw, that the money we will not take as and when we require. it will be safely kept in the bank. That earnings from these accounts will be better than what we will earn in the savings bank account, or that matter current account no earnings. So these are the advantages of fixed deposits or time deposits. In the same fixed deposit and time deposit, there is another version that is called special time deposit. Like for example, in the time deposits and the fixed deposits, the interest will be paid periodically. If you have deposited for 3 years, for example, every 3 months the interest will be paid to the account holder, and at the end of the maturity period, the principal amount, the amount which we invested, is called principal amount. That principal amount will be returned. 1 lakh I have invested, after 3 years I will get 1 lakh. But in between, every 3 months, for that 1 lakh interest, whatever rate is applicable, the bank will be paying. So this is called term deposit. The special version or special term deposit means the interest will not be paid during the period. It will be paid along with the maturity amount. Along with the principal, interest will also get accumulated. Every 3 months interest will be calculated. For that will not be paid to us, but it will be added to our principal amount. That will also earn interest. So that is called compound. In term deposit, we will get simple interest. In special term deposits, we will get compound interest. We will have a detailed view about that in the next episode. Now, the another deposit scheme which we are reviewing was about the recurring deposit. It has the feature of savings bank plus fixed deposit, both. It's a hybrid version, we can call it. In the sense, you can periodically, say every month we can deposit. Like in savings bank, on any time you can deposit. Here every month you can deposit for a fixed period. Say for example 12 months or 3 years. Same 3 years example we can take. So for 3 years we have open an account which is called recurring deposit, meaning thereby every month we will be depositing the X amount. Like for example, if we have planned to open a recurring deposit with monthly 1,000 rupees, every month we will be depositing or remitting into the bank 1,000 rupees in our account. That will get accumulated till the 3rd year. At the end of the 3rd year, throughout the period, whenever we get that money, like first month we have deposited 1,000 rupees. That will be with the bank for 3 years, correct? So that means 36 months. So that will earn interest for 36 months. The second month we will be depositing same 1,000. That will be remaining with the bank for 35 months till maturity, till the last date of the period agreed upon. So according to this, the second 1,000 rupees will earn interest for 35 months. So in that way, it will go on. So at the end of the recurring deposit period, like 1,000 rupees we are deposited for every month for 36 months. So deposit amount will be 36,000 plus the interest for the 36,000. Every month it was getting on accumulated. First month 1,000, second month it is 2,000, third month it is 3,000. From that it will be calculated and will get higher interest with cumulative or compound interest will get. So these are the advantages of recurring deposit. Advantage of recurring deposit mainly is small drops makes a big ocean. Small amounts we are depositing, but at the end of the time we get a big amount for some planned expenditure, education, marriage, or for some investment we can plan now itself. Like chit fund, it is almost equivalent to chit fund. Only thing is in the back, the money will be safe and secured. There is no need to take the risk of running behind the person who is running the chits. So it is ditto. Now we will see a quick glance on the various terms in the banking parlance. Like when we remit the cash into the bank, that is called deposit, crediting money, or remitting. So these are the common terms we are using when we say deposit or credit into my account or remitting into my account. It does nothing means we are remitting our cash or getting our cash into our account. We are paying our cash into the bank account. So that is one common term we always use. Then for taking the money from our own account, it is called withdrawal or drawing from our own account. So these two terms we are using. Then we get interest, correct? When we said other than the current account, all deposit accounts earn interest according to the rates prescribed. So here this is called earnings, interest, or we can always say that it is the return or yield. Normally in financial terms we call it as yield. YIELD, yield. So yield, interest, earnings, all are one and the same. Then we saw in the fixed deposit and recurring deposit, we were always saying for the period, how much period the deposit will remain with the bank. So the period is nothing but tenor. Tenor is also used for the same purpose, and how many months or years, that is also used until maturity date. Till that, the deposit will be remaining with the bank. That is also used. So, like for example, for the period, we use term, tenor, maturity period, and it is equivalent to lock-in period. So these are the same terms which will be used for the period. Then we have various other terms like transaction. What is transaction? It is like when we are remitting the money into the bank account, it is called remitting. That is called transaction. When we are withdrawing, it is called transaction. So any activity into that account is called transaction. So based on that, accounts will be classified as if no transaction happens, it will be treated as dormant account, no inoperative account. So that details we will see in coming episodes. So transaction means operating the account. So in simple terms we can say. Then there is a maturity. We always said no, maturity is nothing but the end of that term. We are deposited for 3 years. At the end of the third year, it is called maturity, matured. So the other derivative of maturity is any, like for example, fixed deposit we have invested for 3 years, but at the end of the second year itself we want the money back. That is called premature closure. Premature withdrawal, premature closure is nothing but before the due date or before the maturity date we are taking it. Then of course there are some other terms like minimum balance, minimum average balance. Those things we will see in the other episodes. For the deposit purpose, we will see that these are the, and how the interest is calculated for savings bank account, how term deposits accounts interest are calculated by the bank. For special term deposit, how it is calculated. For recurring deposit, it is separate chapter. We will see about how the interest is arrived at in the bank, how the savings bank account has a different ball game altogether. That also we will see. So we will see in the chart what are the differences of these schemes.